Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. Quick announcement, we're going to be having a 2-day virtual bootcamp training in September. It's going to be for a max of 3 lenders. To apply, please visit hardmoneymastermind.com. Click on consulting. You can fill out a form, schedule a time to talk to Dave, and he will walk you through all the details. All right, today we're talking about some capital stuff. It comes up pretty frequently in the Mastermind group that some lenders, some lending companies who are members are having trouble controlling their capital investors. And I'll tell you what I mean by that. It seems like some lenders are going into their game plan of raising capital or just, investor relations, interacting with their people with an unclear system. And that ends up creating confusion. We're going to break down a number of different examples, but it's super important to have your program in place. Here's what we pay. Here's how the documentation works. Here's what goes into an underwriting file. Here's what goes into end of year tax reporting. The whole thing laid out for your investors so that there's no guesswork or negotiation required.
Yeah, consistency is key. And the right way to do it is have the same setup with everybody. It can be like, hey, the rate of return's 10%. These are the types of deals that we do. This is the note rate on most of those deals. There's not kind of one-off setups. Everything's kind of the same. Now, keep in mind, this is for the most part the same no matter how your capital is structured. You could have a fund, you could have direct placement, however you have it set up. With these notes, like it doesn't really matter. It's kind of all the same. The important part is the consistency, because there's multiple lenders that we know, and endless stories about folks that have created this business and they're just too far in deep in this, and their capital base just controls them, right? Because they just have so much inconsistency, and they've turned this into too big of a business for that to happen. It doesn't need to, right? They have different rates of return for different people. Some people see these deals, some people, sees these types of deals. Now, obviously, the easiest thing from the beginning is to always have good deals. And I know on this show, we talk about this all the time, is that this is a marketing machine. This is a marketing company. You have to have the best of the best of the best of the best deals, because as long as you have good deals, they're going to work themselves out. Your investors are going to be taken care of. Everyone's going to make money. There's not going to be that many hiccups compared to a bad portfolio where, you could, God forbid, jeopardize losing investor capital. But even if you don't lose investor capital and you end up being made whole, but you're doing bad deals, is you're just playing defense, and it's just a headache, and your capital investors are upset with you because they're not achieving the rate of return you're promising, or they're not getting their monthly payments made, or their quarterly distributions paid, depending on how your structure is set up. So first and foremost, you got to have good deals in place, right? Good deals in place. But again, some of the stuff we're going to talk about is how to structure some of this stuff consistently, so you do it the right way. So it doesn't turn into, in essence, your capital investors making all the rules because they put up all the money. And in essence, you just gave yourself a pretty not fun job.
Yes, we're going to go through a few bullet points here, and also stick around to the end, because we're going to tell you, if you're already stuck in an arrangement with capital investors that you don't love, we're going to show you how to fix it. That's going to be that. That's how we're going to wrap it up. All right. So, clear system across the board. Let's start with rate of return, because obviously this is an important one both on your side and on the investor side. And the reality of investor relations and raising capital is that people are going to negotiate with you. They're going to try. Why? Because they're successful people with investable capital. And part of the reason why they got to where they are is because they negotiate to get better terms. This is just part of, especially with the more active, like the type A kind of investors, or D if you use the DISC profile, they're going to negotiate if you let them. Okay. The passive people, not so much, but a lot of the people that you're going to be raising capital from are active and successful business people. That's just how it is. So sticking to your guns on what the rate of return is going to be, call it 10%. That's about average. Some people a little lower, some people a little higher. Call it 10%, sticking to your guns, even if you need the capital. Do yourself a favor, right? And keep the program what it's supposed to be. When they say, yeah, I'm looking for a little bit higher, I'm looking for 12%, that kind of meets my investment goals. It's like, look, it's the same for everyone across the board. If that doesn't work for your investment goals, I totally understand. It's no problem at all. And, maybe it's not the right fund for you to invest in across the board, even if you need it, even if you have a deal closing next week, even whatever. Do yourself a favor and don't cave, because you will thank yourself later on for sticking to your guns.
Yeah. And what we've realized, and I think a lot of other members of the Mastermind group also are about a 10% rate. It's still double-digit rate of return. It's attractive enough to bigger capital investors that are looking to diversify their portfolio. Even if they have higher interest rate return investments, it's still high enough for them. And, it's kind of a win-win setup. Typically if you're lending out at like 13.3 and your average loan's outstanding for 6 months, like, do the math. The capital investor is going to make 10%. And you're going to end up making like 10%. So it's a good 50-50 split. One thing to also note is, you might come across capital that's willing to invest at less interest rate of returns. But we've also found that, some of those capital investors might be less sophisticated. And there is a level of sophistication, to be a co-lender and, capital investor in this game and understand the risks and the rewards, right? Because there are risks. It's not guaranteed. So, if someone's like, oh, well, I only really need like a 5% return, although that might sound great because you can make more money, the level of sophistication might not clearly be there. So it goes both directions, and typically around a 10% rate of return is pretty industry average in this space.
Okay, next one is documentation. There's a lot of documents that go into the lending business on all sides of it. So that can start with your investor agreement, that they sign the blanket agreement or the private placement memorandum. Whatever agreement goes into place with the capital investor has to be signed, and it's not to be negotiated, right? That's not, again, do yourself a favor. They're not supposed to pick apart your agreement or have their attorney review it. It's just not the way it works. It's written by the lending company. Everybody signs it. And we can tell you from experience here that 95% of people sign it as is. Maybe 5% will say, oh, can we change this, change that? And the answer is no. And then, the rebut is like, look, everyone signs the same agreement, right? This is just how we've always done it. This is how we do it. It's same across the board, right? So they should sign it without too many complaints. Sometimes, again, people just want to negotiate just to get an upper hand, just to have frame control, stuff like that, more so than the actual language in the document. So again, just stick to your guns. That's just one part of it, is the investor agreement. Another one is loan docs. What goes into your loan doc set? You have your attorney doing loan documents. It has all this stuff in it, your note, your mortgage, guarantee, construction agreement, all that stuff. And that's the way it is. Like, there's no need to take suggestions or advice from capital investors on what goes into your doc package. You know what you're doing. You're a full-time lender. You're a professional private lender. Your attorney knows what they're doing. Stick to your guns there too, right? So this is the program. This is the way it works.
Yeah, you should be. Yeah, you should be the expert in this. And and if you're in a position that you're taking on outside capital, in your position of treating this like a real business, like, you need to. And if you're not fully ready, you need to learn everything you can to be ready, or potentially say, hey, maybe I should just lend my own money out first. Whatever that is. The point is not necessarily to trick somebody, manipulate somebody, make them sign something they're uncomfortable with. The point is you're in essence putting these agreements together that are fair agreements for all parties, and they should be professional, and you should have your attorneys, help you put them together based on suggestions that, you want inside your business. Right. And, there's nothing unfair. Everybody's kind of on the same page on these things. So the point is don't, and I don't know if Chris is going to be talking about this in coming up here, but which he might be, but like you probably heard us talk about, not going through and asking your capital investors what they think about a deal, because they're just going to be like, oh, well, yeah, they should bring more money to the table. They should have better credit. Like, not, hey, what do you think about this agreement? Or what do you think about this split? Or what do you think about this rate of return? The point is this is how we structure our deals. This is how we structure our lending business. Would love to have you involved, with this, just like all the other co-lenders or members of our fund. So it's just don't leave things up for question or suggestions, because if somebody comes to me and be like, oh, hey, what do you think about this rate of return? I'd be like, yeah, I'd like it to be higher. I'd like my risk to be lower. I'd like my attorney to redo all this so it's in my favor now. That's the point.
Yeah, who wouldn't if you open that door, right?
That's right.
I mean, we had a Mastermind member come to us recently, and he had a situation with a capital investor who basically wanted to rewrite the servicing agreement to make himself like co-servicer along with the lending company. It's like, no, that's not the way this works. This is a passive investment. You don't need to remix the song in that way. Like it works perfectly fine the way it is. All right. The next one is your underwriting file. What goes into it? What goes into it? You decide. And whatever you decide, stick to that for every loan. For example, are you getting a third-party valuation? If you do it every time. Do you pull credit? Are you getting a bank statement from the borrower? Do you do background checks? You don't necessarily have to do every single one of these things. That's up to you as an underwriter to decide. And whatever it is, stick to it. Let your capital investors know this is exactly what goes into a loan file for a purchase and rehab deal, for a refinance, for a commercial deal, because it can vary, right? And whatever it is, do that for every loan. And this is going to make your life so much easier. There's not, special deals for borrowers, special deals for investors. Sometimes we get this, sometimes we don't. Just keep it cookie cutter across the board. And I know I keep repeating the same kind of thing about making your life easy, but I'm sure there are people listening or watching right now that are like, damn, that's a good point. If I didn't have everything so custom, I wouldn't have to do all this back and forth, all this negotiation with the capital investor, right? And that's why we keep emphasizing that same point over and over.
And custom doesn't scale. If you're doing this,
right.
A lot of members of the Mastermind group are still at like that $1, $2, $3-ish million of deployed capital, maybe their own, maybe investor capital. And, they've gotten away in the past from like, oh, well, we'll do this way. We'll do this way. This capital investor wants it this way. We'll do it here. This borrower wants this. But like, if you're going to stay a small operation forever, whatever, and like you're comfortable with it, then keep doing it the way you're doing it. But especially if you're looking to scale this and turn this into more of a business, it's got to be, and it's got to be consistent. It's got to be the same throughout the board. And it's not a bad thing to do it. But, when things are the same, that means you know what you're doing, and your partner knows what you're doing, and your assistant knows what you're doing, and your controller knows what you're doing, and your accountant, and your borrower, and your capital investor. There's a lot of parties that are involved. And if you have, one-off deals back of the napkin that only you know what's going on with, that's just a recipe for disaster. And you're not just hurting yourself, you're hurting your team, and you're going to hurt capital investors the same way because things weren't done, appropriately. And that's why, it's scary to us when we see new lending operations scale so darn quickly, because I know they're not putting the foundation in place and they're not doing things the right way. They're just doing deals over and over and over and over and over. And yeah, they can go back and potentially clean up stuff, but that's challenging to do. So just do it the right way from the beginning and keep things consistent. It'll make your life way easier.
All right. So to wrap up here, if you're already in a situation with a capital investor that you don't love, I'll give you an example. There's a lender in the Mastermind group who started out lending private capital mainly from one investor and has since grown over time. And that was probably 5-7 years ago. And they're paying the capital investor the full note rate of 12 or 13%, which is not necessary or customary in this business. There should be a servicing fee right around 80-20 is normal in the industry. If you're paying out 10 and your note rate is 12 or 13 and you're keeping 2 or 3% as a servicing fee, that is totally normal and you should be doing that. But in this particular case, the lender feels stuck in the situation because this is how they started with that investor. Now, we can speak from experience on this one because we have a similar situation way in the past, in early HMB days, when we were paying out more than we wanted to. Even like paying a point and like paying too much of the note rate to an investor. And how do we fix that? Well, we fixed it with supply and demand. Once you raise enough capital outside of those investors who are getting too good of a deal at the beginning, once you raise more capital, you can bring them down to where everyone else is. It's very easy. It's not a like tough conversation. It might be slightly uncomfortable to renegotiate with somebody, but look, investors understand supply and demand, and they understand that if you have a bunch of 10% capital, you're not going to want to use their 12% capital, right? They understand that very well. And the reality is they still want to be in the game with you. They still want to invest in your deals. They're performing well. They're paying well. They want to be in the game. They'll take 10%. All you have to do is raise enough money so that you don't rely on them, so that you have other options. We've done this ourselves a number of times with a few different investors. And also, like, things were different when we started. Like, note rates were way higher, rate of return was higher. So that aside, it was still a renegotiation based on the fact that we had raised enough capital that we didn't have to bend to the rate of return that they required at the beginning. They came down to where we are, right? Because we had the program in place. It took some time. It took some time of like raising capital, building our portfolio, getting our systems in place, documentation, software, everything else. And then everybody completely fell in line. They all got with the program. And that's where you want to be, right? Keep things simple, keep things cookie cutter, keep things fair for everyone involved. There are good rate of returns in this business, good points, good interest rate paid. There's plenty to go around, but it should be fair on both ends, right? You as a lending company, just because you're in capital raising mode doesn't mean you need to totally bend and give an unfair deal to yourself and too good of a deal to the capital, right?
Yeah. And again, this all comes back to, treating this like a business, and every day, if you're in growth mode, every day, spending time finding new deals and finding new capital every single day.
That's the job.
And the advice that we gave to one of the big lenders, big, I mean, they're a big size lender who just gets controlled, just bent over backwards every day by their capital investors. And it makes it very, very challenging for them to want to be involved and do more deals because their capital investors just runs the show. It's like, you know what? And they don't necessarily need to raise more capital because they have capital to do all their deals, but they do, right? Because now they have to go back and do it the right way. So every day you're out there raising more capital to replace these crappy investors, or it's going back to these investors and not renegotiating, just explaining what their involvement is and what your involvement is. And if you do that, it'll make your life easy, right? And like, that's the purpose of this. And it's the same thing. The flip side of this is the same thing when there's too many hard money lenders giving 100% financing or 95% financing because they don't have enough deal flow. And they're scared that, oh, well, if I don't do 100% financing, I'm not going to get this borrower. Then I'm not going to have a deal this month or 2 or 3 deals this month. Go find some more borrowers that will put down 10, 20, 30%. Go find new capital investors that potentially, will adapt to what you do. So that's the important part. And, one other quick kind of note related to this, because this isn't necessarily like you're the smart guy and the capital investor's not. Like, if you do have capital investors that are continuing to get upset with you, they're saying no to your deals, they don't want to be involved in your fund, whatever that case is, then maybe it is you. Like, maybe you have to do a little reality check of like, hey, maybe I'm not at the point right now that I should be taking on other people's capital, creating this big fund and things like that. Maybe you got to go and start finding some more opportunities and more deals, because typically, and I can say this for a lot of folks in the mastermind group, a lot of people we've done training with, because we talk to them, like, the closing rate for getting capital investors in your fund or in your direct placement notes should be very high, very, very, very high. You have a very, very good asset, a very, very good note, very, very good loan, real estate investment note deal that they want to be involved in, or that, or, is a good deal. They want to be involved in it. They want to get that rate of return on these things. And after you get an investor in the door, typically they're in there for a long period of time. It's not like they got that rate of return. They're like, oh, I got this 10% return. It was a 6-month deal. I got paid out. Or, I put my money in the fund for 6 months and I keep getting good rates of return. I think enough is enough. I'm going to go find another investment at this point. It doesn't work like that. They want to stay in the game. So after you kind of create a trail of raising money, it should make your life way easier to continue to raise more money from that same person. They bring in their friends, they bring in their family members and things like that. And it just turns into a good relationship. So if you are kind of batting out with capital investors, it could be you. And I think a lot of it could be, it could be your presentation, or it could just be that you just don't have good deals. Because I know if you go through and you tell your capital investor, hey, so I got this deal, it's in this market, which you're in, capital investor. The borrower's putting up, 20% or 30%. They got good credit. They've got experience. They've got this. They're paying this rate of return. Most of these capital investors will be like, oh, wow, like that's a really good deal. What am I missing? So if you're
How
not
do you get deals as good?
Yeah. How do you get deals as good? Or why won't they just go to their bank? Well, that's a good question. Well, they can't go to their bank because this deal needs to close in 5 days, and the banks don't like construction loans, and they certainly can't close a loan in less than a month. So that's why real estate investors are willing to pay a higher rate of return, for the ease of the capital, the ease of the use. Like those are buy questions for capital investors if you're having investor meetings with them. The point being is if they're not having that feedback to you, then maybe it's not getting presented right, or your deals aren't strong enough. So that's important. Like, I'm not saying necessarily like just be irresponsible and have crappy deals and expect your investors to follow. That's not going to happen, but they organically should, and you should be able to control the capital the right way if you're following this and you're staying consistent and you're putting good investment opportunities in front of them.
All right, everyone, that is the pod for today. Thank you for checking out the show. We'll see everyone inside hardmoneymastermind.com and here next time on the podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.